We're going to walk through Form A for Exam 1 quickly. We went over it so many times in class, the two fundamental rules of accrual basis accounting. I think we did this every day. Our revenue recognition, we record revenues when they're earned. That is when the goods are delivered or we perform a service, regardless of when cash is received. Millersville, you pay your tuition first in August, but Millersville doesn't have a revenue until they perform the service. The matching principle says we match costs by recording them as an expense with the revenues they help generate. We don't match revenues with expenses. We record revenues when we deliver the goods or perform the service. For number 2, we had to calculate the revenues for July. So that's when we perform a service or deliver goods. A, we had services in July, a revenue for July. A customer held a party at the center on the last day of July. The service was performed in July. This is a revenue for July. The bowling league made an advance payment for the season that starts in September, just like you pay in advance in August for Millersville's classes in the fall. There's no revenue until, in this case, September, when the games are played. We received $2,500 from a customer for a sale made last month in June. This was a June revenue. For this problem, our financial statements, we simply need to put the accounts where they belong. So you need to know from our account quizzes what goes on the income statement, what goes on the balance sheet. Once we have our accounts on our financial statements, then we can simply start solving for the unknowns. First, we'll total up total assets. That was the first question we had. Next, we know total liabilities have to equal total equity. And that since this is our first year in business, beginning retained earnings is 0. So there's our liabilities equal equity. Beginning retained earnings is 0 since it's our first year in business. Next we can solve for total equity. If liabilities are 50 and liabilities and equity are 93, the difference is total equity of 43. If we have 40 in common stock, we can solve for ending retained earnings, which are 3. Ending retained earnings goes on the in the statement of retained earnings, along with net income, which increases retained earnings, and dividends decrease retained earnings. So we can go from our final thing will be a solving for dividends. So 0 plus 12 minus what equals 3? That would be 9,000 for the plug for dividends. Our first transaction, we're told that we received shareholder cash contributions totaling $4,000. So we get cash and asset increases, and we increase assets with debits. And the credit would be to common stock, which is the shareholder's equity. This does not affect our income statement because we're not providing a service, so there's no revenue, and we don't have an expense, so there's no change on net income. And this is a financing cash flow. We've raised cash from outside investors. On January 4th, we purchased a $1,500 computer. This would be an increase in an asset, computer, $1,500. We paid $500 in cash, so cash decreases, and we decrease assets with credits. So we credit cash $500. And we were billed for the balance, so we have an increase in accounts payable for $1,000. Again, this does not impact our income statement because it doesn't involve a revenue or an expense, so there's no change. And this is a cash outflow, and it's for the purchase of a long-term asset, so this is an investing cash flow. Number 3, we receive $400 for packages billed and delivered in December. So we received $400 in cash. We billed these sales or services. The services weren't in January, but we delivered them in January. So we had a January revenue and a January receivable. So we billed them. The customer owed us the money. So now we want to reduce the accounts receivable. This does not involve any revenues or expenses. so there's no change to net income. It's a cash collection related to the operations of our business, so we have an operating cash flow. We've billed customers $2,000 for packages delivered in January, so we have provided a service. So we're going to have service revenue of $2,000. We're not getting cash, but rather we're sending out a bill. So we have an accounts receivable. When we have our service revenue, this will increase net income. There's no impact on our cash flow statement because we have not received any cash at this time. When we collect this receivable, we will have an operating cash flow. 5, we've received $600 for February package deliveries. We've received $600 in cash, so we will debit cash for $600. The deliveries or service won't be until February, so at the present time we don't have a revenue, we have a deferred revenue, just like you're paying Millersville tuition ahead of time. So the customer is paying us in January for packages that will be delivered in February. We have a deferred revenue. We have no change for net income because we haven't provided a service. We have no revenue, and we have no change in expenses. We did get cash, and this does relate to our operations, so it will be an operating cash flow. Number 6, we paid $800 in wages to employees for work done in December. So we've paid $800 in cash. We're going to have a decrease in cash, so we'll credit cash for $800. Since this was for December wages, it's not work that they're doing in January. They would have recorded or performed services for us in December and generated December revenues. So we would have recorded a wage expense in December and wages payable. So we've got a decrease in a liability, wages payable. This doesn't involve a revenue or an expense, so there's no change in net income. But this is cash going out, and it does relate to our operations. So this is an operating cash flow. We received an electric bill for $300 for January electric services, and we're going to pay it in February. So we've got an accounts payable for $300. Since this was services during the month of January, we want to match that cost, that $300 cost, with current revenues. So we're going to record a utility expense of $300. Expenses, of course, will decrease our net income. This does not involve a cash flow at this point in time. In February, when we pay the bill, we will have an operating cash outflow, but for now, there is no change in cash. We paid $1,400 in rent for January and February, so we've paid 2 months of rent. Our cash has gone down by $1,400. Half the rent is for January, so that will be a rent expense. The other half of our rent we are prepaying for the month of February, and we have an asset, prepaid rent. The expense will, of course, decrease our net income, and this does involve a cash flow related to operations, so we've got an operating cash outflow. We pay the balance due for the computer purchased on January 4th. The easiest part of this is a decrease in cash for $1,000. And since this was for a computer, it is an investing cash outflow. Of course, the balance due, if you recall, when we purchased this computer, we recorded an accounts payable for $1,000. So we will reduce that liability by debiting accounts payable.